Well, as we all enjoy the holiday season and all that goes with it, it's not too early to consider what is likely to happen from an investment standpoint in 2014. While this year has been a solid year, certainly next year will be different in very important ways. So what should we expect? For perspective on that important question, we turn to our Jim Russell, U.S. Bank Wealth Management Senior Equity Strategist, who is joined this week by Mindy McLaughlin, U.S. Bank Wealth Management Senior Portfolio Strategist. Jim and Mindy?
Brian, thank you. This morning we're honored to have Mindy McLaughlin, who's our Senior Portfolio Manager with us at U.S. Bank Wealth Management. Mindy, welcome and happy holidays.
Same to you.
Yeah. Mindy's going to shine up her crystal ball today and let us know maybe what's on tap for the year of 2014. So let's maybe rewind a little bit, set the table. What worked well in 2013 and maybe what did not?
Sure. It was a great year for domestic stocks. We saw returns in the range of 25 to 30%. A lot of those higher numbers came from small cap companies as well as lower quality companies. Developed international stocks posted a pretty nice 14%.
Right.
But then you had emerging markets, commodities, and bonds, which really didn't fare too well last year.
Understood. Those are big numbers, though, across the board, right?
Yes.
You know, surely 2014 will be a little bit different than 2013 in probably some important ways. One of those important ways may be the interest rate scenario. Can you maybe go into some detail there?
Sure. Well, Jim, as you know, and I think we've spoken about this on this program before, as interest rates rise, bond funds actually decline. So, and the reason there is because bond funds never mature. So as we saw interest rates move up in 2013, a lot of bond funds suffered principal losses. So it's really not an inflation issue. That's not what's causing the interest rates to rise, but it's more of a normalization of rates, and then certainly now with the expectation, and now we know the actual Fed tapering, that's going to impact things even more. Next year, we think the 10-year Treasury note yield will finish between 3.4 and 3.75%. It's at around 2.9, close to 3% right now. So for those folks that own longer-term bond funds, they may experience principal loss again next year.
That would be an important difference. That is rates on the rise. They've been so calm for so long. Maybe a change of foot, right?
Yes.
Okay. Many of our viewers, Mindy, own stocks through 401ks, other types of vehicles as well. What is the outlook by U.S. Bank Wealth Management for 2014 for the stock market?
Sure. We do still feel there are some opportunities there. European stocks in particular look pretty good to us right now. Europe has been in a recession, and we think that's improving there. A lot of those stocks are trading at pretty low valuations, about 11 times earnings. And certainly with kind of a slow growth, low inflation environment, as well as an accommodative central bank, we think there's some opportunities there. On the domestic front, we still like the S&P 500. Do think that you know, we're approaching fair value. One of the metrics that we look at is the price to earnings ratio, and essentially what this is, the bigger the number, the more expensive stocks are. So as you can see, you know, we are approaching kind of those historical norms, but we think there's still room to run there, and we're actually forecasting about a 7 to 9% total return,
a solid year,
including the dividend next year, which isn't bad for high quality stocks. And I think it's going to be the kind of a year where dividends really do matter. We've seen some recent announcements with GE, 3M, and Boeing, to name a few, where they've increased their dividends, which is a nice pay raise.
Sure it is.
The other thing is, I think if the global growth dynamic unfolds and plays out, we may also see a shift from small cap leadership domestically to large cap company stocks. So we'll see how the year unfolds.
Boy, important stuff to keep in mind. Mindy, thanks for joining us today. Happy New Year, happy holidays. Brian, back to you.
All right, thanks, Jim and Mindy. As always, we are grateful to you and U.S. Bank.